What did you learn in the last 48 hours from OPEC Plus?
Well, look, I mean, I think OPEC's always reactive to prices, and we had a big run-up in prices in the first half of the year, so they reacted by increasing production. We've had a very meaningful pullback in the past few weeks, so now they are reacting to it, right? What's interesting is that Shale and OPEC seem to be reacting competitively, because one of the things that hasn't been mentioned enough, right, and I just came up with this stat on Friday, is that October 2018 is America's energy independence month.
Is it really?
Yeah. So last month America became fully energy independent. There's, if you net it all out, both from a calorific value as well as from a dollar perspective, America is no longer a net energy importer; it's a net energy exporter. And much of it is really the fact that we've had a huge surge in U.S. production in the past couple of months that's gone really, has really come under the radar, and is one of the reasons why prices have rolled off quite a bit. So I'm not sure how OPEC is going to factor into their decision in the next meeting in December.
I have to say, one of the fascinating things to me is it was not too long ago, a week, 2 weeks ago, it was all about Iranian sanctions,
right,
and how that was really changing the world. Does this really play into President Trump's hands? Because he has the best of all possible worlds: low oil prices and being able to really punish Iran.
He has a pretty strong hand right here. I mean, you're right. I mean, he's got lower oil prices. He's part of it. I think OPEC increased production, as we said earlier, in June and July, because prices were rising. At the same time, just the U.S. industry responded too. So now we find ourselves with a bit of a glut. Now, having said that, remember, going into December, all the refineries also start ramping up, so there will be a seasonal pickup. Presumably lower prices will encourage a little bit more demand. Emerging markets seem a little bit more stable. So all those factors, I think, will help. But you're right. I mean, he has a pretty strong hand right here. He can go harder on Iran in the next 6 months.
And the chart that we just pulled up showed OPEC looking at supply builds now for 2019, which is what, you know, Saudi Arabia was saying what their thesis was. Barkindo speaking to Bloomberg right now, saying that oil demand growth is going to be below 1.5 to 6.5 million barrels a day in 2019. What's the demand picture like?
Well, the demand picture, one of the challenges that the demand picture has, and I think we've talked about this before, is that you have a world of higher tariffs, and you also have a world of higher interest rates. And at the same time, this is kind of sucking liquidity out of emerging markets. For the last 10 years, emerging markets have benefited from high liquidity and relatively tight fiscal policy in the developed world. That's changing. Now we have loose policy, but equally we have tighter monetary, and that's effectively reducing the amount of money available for emerging markets. We've seen that with Turkey, Argentina, South Africa going into recession this year, but I'm particularly worried about China, because China is facing all these headwinds at once. And they are the world's largest oil importer, by the way. I mean, let's talk about that too, right? I mean, if oil prices go up in the context of higher interest rates and higher tariffs, the Chinese are in a relatively weak position. So to me, the key date in the next few weeks is going to be that dinner, G20, Trump and Xi. Do they agree on something, or are we going to see a full-blown trade war starting on January 1st?